The banking sector getting a boost when the Fed decided on that jumbo 50 basis point cut. With regional banks in particular positioned to take advantage of lower rates, where should investors be looking for more value ahead? Just a few minutes left before that closing bell on Wall Street, we are looking at how to play regional bank stocks with the Yahoo Finance playbook. Joining us now, we've got Christopher McGratty, KBW, Stifel Company, and head of U.S. Bank Research. Christopher, it's great to have you here. So talk to me about kind of the relationship between rate cuts moving forward and regional banks. We love to have the 25-50 debate. I'm sure you and your colleagues do as well. How important is the degree of rate cuts this year for regional banking stocks?
Great, thanks for having me back. The 50 basis point move was in much debate, going into the Fed meeting in mid-September. But really, from here, we think the path is more 25s, and ultimately we're more concerned about where you land on rates. And as a firm, we think rates are going to 3% by the middle of 2025. The banking industry typically does better when rates are going up than down. But given the speed at which we tightened over the last couple of years, the opposite is true. We think banks will actually do better. Earnings will expand at a better pace as rates go down over the next 1 to 2 years.
So, Christopher, as rates come down, banks might do better. Is it all regional banks that we're talking about here? Should I be buying the regional bank index, or is there something that you're scanning for that makes certain regional banks better than others?
It's a bit of an unwind or a catch-up trade. As the yield curve has disinverted, we have a positively sloped curve for the first time in a couple of years. Traditional spread-based lenders should do better. So banks that make their money loaning money out and making a spread, they should do better as rates come down. We think companies like Comerica, historically one of the banks that you'd want to own on the upcycle, is actually one of the best plays on the way of the down cycle. Part of that is because of the balance sheet setup with the swaps that they put on. But overall, the small regional banks should do better than your traditional universal money center banks that did better on the way up. So it's a bit of a torch passing between the groups.
Okay, so Comerica is a buy for you, but what is a regional bank stock that investors should be wary about?
I think commercial real estate broadly is still an asset class we're concerned about. It's gotten a lot of attention as rates were going up. Banks are really doing a lot to take down the commercial real estate concentration. On average, a small cap bank has about 40% of their loan book in CRE. So we're generally a little bit more cautious than that. Now, having said that, lower rates help cure some of the problems. So we think credit quality is in the process of normalizing, but lower rates will certainly take off some of the pressure for commercial real estate.
Chris, you say regional banks, and I think some people still have a bad taste in their mouth, right? From a few Marches ago, and you think about Silicon Valley Bank or one of the other regionals that struggled. How much of an issue is what we saw there still in the space, or is that not an issue that investors should still have at the top of their minds?
No, there's still scars. There were some pretty severe moves last March, but we have picked up the pieces. The industry has proven resilient. The deposit situation at the industry level has proven resilient. We're back to growth, and more of the conversations are less of the conversations are about sustainability and will the bank survive? But it's also like what is the normalized earnings power of the sector as we've picked up the pieces, and we think over time in 2025 in particular we're going to see positive earnings growth. We haven't seen positive earnings growth in a couple of years. Earnings we believe will be down 8% this year, will grow 8% next year, and will grow 12% in 2026. So there is a path towards improved returns for the sector, and I think that's a good sign to be.
I want to kind of put a button on that, though, because I get what you're saying, that it's a little bit more of a long-term play, but I am concerned about this idea, or I guess investors may be concerned about this idea of future rate cuts already being baked into regional bank stocks. To what extent do you think that is the case right now?
Sure, the group has acted better, but we put out a big piece this week that looked at long-term multiples and the outlook, comparing that to the outlook for net interest income growth. If you look at the average multiple for a regional bank, a small and mid-cap bank, for example, we're still 15% cheap to the 7-year average. So there is room for the multiples to expand. We think they expand for two reasons. Number one, if you start to see positive revenue growth. And number two, if we can prove out that the credit situation is more stable than people had feared a year ago. If those two happen, you've kicked out two of the large bear theses for the stocks. But banks have moved, but they're still 15% cheap to long-term averages.
Chris, we were talking about the Fed cutting at the beginning of this, and we know the path is lower now. Maybe it's 25s, 25s. I guess to throw an alternate scenario at you, there's still that no landing scenario out there that some people would pitch to you, right? That the economy keeps doing better than you expect, and we just get far less rate cuts over the next 12 months than you expect. How much does that hurt the case for regionals?
Yeah, there's a lot of expectations for the cuts. I would say as a firm and as an analyst, over the last 3 to 4 months, I've definitely moved and I've tilted the portfolio, if I were managing money, to less higher for longer stocks and more banks that will do better in a down rate scenario. I'll give you a couple of examples. Comerica is a stock we upgraded September 4th. Really, when the Fed cut, we thought the capital improvement and the earnings improvement narrative really got easier. At the same time, we took off 2 of the best performing higher for longer stocks, Wintrust Financial out of Chicago and First Horizon out of Memphis. The fundamental stories, in our opinion, have played out. I don't think we can totally abandon, banks that do well in higher rates, and I don't think we can totally go to one end of the boat for down rates. So you do have to have a balance, and I hear you there. But I think in general, the incremental dollar into the space is coming into banks who you believe will benefit from down rates.
Chris McGratty, we're going to have to wrap it there. Appreciate you joining us today.
Thank you.